Hey there, fabulous financiers. Welcome back to another episode of Do.Different.Better Show, where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connective Institute, and managing director of the Integrated Capital Fund. Thank you for joining me today. In our last episode, I broke down what bonds are, how they work, and the different types you can invest in, from government bonds to social impact bonds and corporate bonds. I shared how they can provide steady income, preserve your capital, and diversify your investment portfolio. I also compared stocks to bonds and explained why bonds are a safe haven during market volatility, and also give you some really practical and tactical tips and resources. And today, we're going to be talking about the most accessible and underutilized tool in the finance and investing toolbox. What am I talking about? Insurance. Now, before you roll your eyes, hear me out. Insurance can be a very big key element in your financial plan and can provide protection for you and your loved one in times of unexpected events or emergencies. So let's get into it. So what exactly is insurance as an investment? When people think about insurance, they think about it as a safety net, a way to protect themselves and their loved ones from unexpected events. And yes, insurance is definitely that, but it can be so much more. Insurance as an investment means using certain types of insurance policies, not just to provide coverage, but also to build wealth over time. These policies come with a savings or investment component that can grow, sometimes substantially over years. This dual role makes insurance a powerful tool in both protecting your assets and enhancing your financial future. But you're probably asking, Elaine, why is that important? Well, in order to provide financial security, these types of insurance policies can offer significant growth potential. They allow you to build out a cash value that can be borrowed against or even withdrawn in retirement. They can be a great way to ensure that you're not only protected, but that you're poised for financial success. So, first, let's define insurance. Insurance is a contract between an individual or an entity and an insurance company where the individual pays a premium every period, whatever that is, monthly, annually, biannually, in exchange for financial protection against potential losses. These losses can include property damage, medical expenses, disability, liability, or even death. There are different types of insurance available depending on your needs and circumstances. The most common ones are life insurance, health insurance, disability insurance, and property or casualty insurance. Those are fancy words for homeowner, renters, or autos insurance. You've probably heard many of those. Today, I'm mostly going to be going over life insurance for the most part, right? So, what are the different types of insurance that can be used as an investment tool? So, let's talk about it. There are a few key ones that you need to know. Once again, these are under the umbrella of life insurance. So the first one is whole life insurance. This is a permanent life insurance policy that provides coverage for an entire life. As long as the premiums are paid, it builds cash value over time, which can be borrowed against or withdrawn. Universal life insurance. Similar to whole life insurance, but it has a little bit more flexibility. You can adjust your premiums and death benefits, but it also accumulates cash value. Variable life insurance. This type allows you to invest the cash in different investment options such as stocks and bonds. This means that the cash value can grow based on market performance. Here's a fun fact. Many wealthy people use life insurance as a key part of their financial strategy. According to PBS, Reginald Lewis, the first African American to build a billion-dollar company, used life insurance policies to secure capital for his business ventures. This smart use of insurance allowed him to access funds when traditional financing was not available, helping him grow his empire. Also, Walt Disney used cash from his life insurance policy to help fund Disneyland when banks wouldn't lend him the money. So, the second type of insurance is an annuity. Fixed annuity, there are two kinds. There's fixed annuities. These are regular guaranteed payments, making them a very stable investment option. Then there's variable annuities. These offer the potential for higher returns since they're tied to market performance. So when we say market, we're talking about the stock market typically, but they come with more risk. So there are companies you may have heard like J.G. Wentworth and other financial institutions that may negotiate an annuity payment in exchange for a lump sum of payment, or you want a lump sum payment to be converted into annuity. So here's an example. Someone runs into you with their car, or you have an industrial accident at your employer's fault, or whatever. You sue, and before the trial, the opposing lawyer agrees to a settlement of $4 million paid out over 20 years. The lawyer talks you into accepting it. The lawyer gets his 50% contingency fee. So you are left with $2 million paid over 20 years or $100,000 a year. Well, that will keep you fed and clothed and housed, but what if you decide you actually need cash now? Well, that's where companies like a J.G. Wentworth comes in. They buy that structured settlement from you. So instead of $2 million over 20 years, they give you $1 million cash now. The company will continue to get the monthly payments over 20 years instead of you, because you got your cash today. So basically, they got $2 million and it only cost them $1 million, right? 100% return on investment. So annuities can be a great way to ensure a steady stream of income and provide you peace of mind if you know that you won't outlive your savings. The third type of insurance is long-term care. This type of insurance helps to cover the cost of long-term services, which can be incredibly expensive, particularly as you get older. My mother-in-law had two long-term care policies, and it was really great because as she was getting to the end of her life and had to go into hospice care, and if you've ever had to do hospice care, it is very expensive. She had those two policies pretty much covered all of her expenses. One policy covered, I think, 60 to 80% of her expenses, and another one was only set up to pay for 20%. So between the two of them, all the expenses were covered, right? But anyway, by protecting your savings and investments from these costs, long-term care insurance can act as a safety net and an investment in your financial future. So now let's talk about how insurance as an investment works, right? Let's get into the mechanics. First of all, let's talk about premiums and cash value. When you pay a premium on certain types of life insurance, a portion of that premium goes into what's called a cash value account. This account, you can think of it as like a savings account. This account grows over time, either at a fixed interest rate or based on market performance. Remember the stock market. When we say market performance, we're typically talking about the stock market. But this will depend on the type of policy. Once again, you want to read the policy and make sure you understand what is happening. Then there's growth potential. The growth potential of these policies can be significant. For example, the whole life insurance, the cash value grows at a guaranteed rate, and you may receive dividends if the insurance policy performs well. With a variable life insurance, your cash value growth depends on the performance of the investments that have been chosen, which could lead to higher returns. But here's the big one, tax benefit. The growth of your cash value in these policies is typically tax deferred, meaning you do not pay taxes on the gains as they accumulate. Plus, if you borrow against the cash, that loan is usually tax-free. This can be a smart way to access funds without triggering a taxable event. Like, if you were to receive an inheritance would be a taxable event depending on the size of the inheritance, right? So that money usually can be taken out pre-tax. Obviously, if it's taken out after you've already paid taxes, then even when you cash it out, you're not going to pay taxes. But this means you're not paying taxes on the money. As the cash value accumulates, you're not paying taxes on that in the moment, right? So what's the call to action here? I want you to look at your current financial strategy and see if there's room to incorporate insurance as an investment tool. It really might be the game changer you need to secure or add to your financial future. So, that's it for this first segment. I gave you a broad strokes understanding of insurance and as an investment tool. We talked about what is insurance, the different kinds of insurance, and how insurance works as an investment tool. So I want you to stick around and come back because in the next episode, we'll dive into the benefits and risks of using insurance in this way. Stay tuned because you're not going to want to miss how I show you how to do different better. Welcome back to the Do Different Better Show. I'm your host, Elaine Rasmussen. If you missed it in the last segment, we covered the broad strokes of understanding insurance as an investment tool. We talked about what is insurance, the different types of insurance, and how insurance can work as an investment tool. In this segment, we're diving into the benefits and the risk of using insurance as an investment tool. So let's get into it. Let's first talk about the benefits of using insurance as an investment. Number one, it's great for risk mitigation, which means you're reducing your risk, right? Insurance is fundamentally about protection. By using insurance as an investment, you're adding a layer of security against unexpected financial burdens. This means that if something unforeseen happens, like an accident, illness, or even a market downturn, your insurance can help cover the costs, protecting your other investments like your home. Two, guaranteed returns. One of the attractive features of certain insurance products, like whole life insurance, is the stability that they offer. These policies often come with guaranteed returns, which means your cash value grows at a steady, predictable pace. This can be particularly appealing during times of market volatility, right? Particularly, a lot of people will buy insurance policies when they're younger to then take advantage of them when they're older, right? Letting that money sit and accumulate in value, right? Here's a little fun fact. Did you know that the cash value in some whole life insurance policies can grow by 4 to 6% annually, and that's tax deferred? That's pretty on pace with the stock market, and it's far less volatile than the stock market. That's a pretty solid rate of return on a very low risk investment. Number three, estate planning. Insurance can play a very critical role in managing and transferring wealth efficiently. Life insurance policies can provide a tax-free death benefit to your beneficiaries, helping to cover estate taxes, ensuring that your loved ones are financially secure. My mother-in-law, when she passed away, all of her funeral expenses were taken care of because of her life insurance policy. So that alone, I don't know if you've seen the cost of burying somebody nowadays. It ain't cheap. It can run upwards of $10,000. And that's for something very simple. My mother-in-law was cremated. She had a plot. All of that fortunately, she had taken care of all that. So go back to my episode on estate planning. You are doing your family a favor. Please, 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 please check that episode out. But because all of that was taken care of with the payout of the insurance, no out-of-pocket expenses were imposed on any of her children, right? But there are some risk and considerations that I really want you to be aware of. I'm not going to just give you the sunny side. I'm going to give you the other side because I want you to go in with both eyes open. Let's flip the coin and talk about the risk and conditions of using the risk and considerations of using insurance as an investment. One, there are costs. Insurance products, especially those with an investment component, can be expensive. There are monthly premiums or regular premiums. There may be management fees and other charges that can add up quickly, eating into your returns. So it's really important for you to understand all the costs involved before committing to a policy. If you're working with somebody who is an insurance agent or a certified financial planner or an investment advisor, if you're not sure what those are, listen to my previous episode where I break all of that down. Or I'm sorry, my next episode where I break all of that down. You're going to want to know upfront, what are the ongoing costs? What are the ongoing fees? What is the monthly premium? Will the monthly premium increase? Will it decrease over time? What is expected of me? Do I need to check in? Is there something I need to do on an annual or a quarterly basis? Ask all these questions of what is involved with this particular financial vehicle or instrument, right? Um, these costs can be really significant and impact your return. So you really want to have a really clear idea as to what they are. So you go in with your eyes wide open. Number two is the complexity. Insurance policy with investment components can be complex and difficult to understand. Terms like cash value, surrender charges, and riders can be confusing. It's essential to thoroughly understand the policy you're considering, and you may possibly want to consult with a financial advisor. So once again, we're going to talk about certified financial planners and investment advisors in the next episode. So definitely encourage you to check that out, and they can help walk you through understanding some of these financial options. It's always a great idea to read the fine print, even if it means you need to take it home to read it. You don't have to sign right there in the office. Sometimes somebody will make you feel like you have to sign right then and there. You do not, right? Take it home. If they don't have a mechanism by which you can read it offline outside of the office, I would be very concerned. Ask questions, highlight with the parts that aren't clear, and have a follow-up conversation. It's better to spend a little time extra upfront to understand the policy so that there are no unpleasant surprises. Kind of the old adage of measure twice, cut once. Well, this is kind of the same. Read twice before you sign, right? Then number three is liquidity. Unlike stocks and bonds, which can be sold relatively quickly, insurance products lack liquidity. Accessing the cash value might involve fees, it might involve penalties, and it may take some time. You may have what's called the name is escaping me now, but a redemption period. There may be a closed redemption period, meaning that from the time that you notify them that you want to cash out, might be you cannot cash out for another 6 months, or you can only cash out during this open period, or whatever those things are. Once again, reading the fine print and asking some of those questions will help you know that upfront before you get into a situation where you actually need the money and you don't have access to it, right? You should be really cautious about relying on insurance for short-term financial needs. It's not that you're really using insurance for a long-term game plan, not a short-term game plan, right? So here are some real world examples and case studies that I want to share with you to bring some of these concepts to life and give you some real world examples. So, if for any of you who have seen the movie The Big Short, if you haven't seen it, highly recommend it. You may need to watch it a couple times to get through all of the jargon, but they think they do a pretty good job of breaking down some of the jargon so it's easy to understand. But Dr. Michael Burry, who's the main character in The Big Short, famously used insurance policies called credit default swaps, just another name for insurance, to bet against what the data said about the types of mortgages in the bank's investment portfolios. Understanding the underwriting flaws in the mortgage system and other reasons which I won't cover in this episode, he saw an opportunity to profit by purchasing these insurance contracts on these mortgage-backed securities. By doing so, he essentially placed a bet that the mortgages would default en masse, right? Burry's keen insight and unconventional strategy ultimately paid off, making him one of the few who successfully predicted and profited from the 2008 financial crisis. But don't forget, he had to make the insurance premium payments over several years before his bet paid off. Now, I'm not telling you to go out and see if you can predict and profit off the next national crisis. My point here is that insurance can be used in even more sophisticated ways once you have a proficiency in understanding how you can protect and build your assets. Then there's estate planning. Many families use life insurance as a way to cover estate taxes, and provide for their heirs. This can prevent the need to sell off family assets like a cherished home or a family business to pay any outstanding taxes that might be due as a result of the estate or any other activity that's happened as a result of the person's death. Two, I want to talk about some pitfalls. First one is uninformed decisions. Take the case of a family who bought a variable life insurance policy without really understanding the fees that were involved. Over time, the high fees eroded their returns. They ended up with less than they anticipated. This underscores the importance of understanding all costs and asking lots of questions. You can never ask too many questions throughout the process. Once again, liquidity issues. Another example involves an investor who needed quick access to cash for an emergency, but found that accessing the cash in the whole life policy involved significant penalties. This situation highlights the need to maintain other liquid assets and having a portfolio, some of which you can access quickly, some of it that you're going to access over time. And that's what a certified financial planner and investment advisor is going to help you figure out. Like, hey, it's kind of like you're looking at yourself as a business. If I know that I'm going to start a family in 5 years, or that's my plan, I'm going to need an infusion of capital. So let me make an investment now that will have a payout in 5 years so that I can afford to grow my family, right? And in 5 years, like my plan, right? Now, let's say for some reason in 5 years, you don't find yourself in a situation where you're wanting to or able to expand your family. That's okay. You still have this financial instrument that's still working for you, even because of your past planning. Thank you, past self, right? So these are the things that you really want to understand and that you really want to know as you're building out all of these perspectives of thinking about using insurance and what you need to be aware of. Look, if you currently have insurance, whether I would go to your job and see, does your job have an insurance policy on you, right? Sometimes you have an insurance policy. A lot of times companies, and this was really particularly in the 80s and the 90s, I'm not sure what are happening with corporations right now, but what you can look at is, does my company, my employer, have an insurance policy on me, right? And that I get to benefit from. You'd also want to know, do they have an insurance policy that they benefit from? And I'll talk a little bit more about that in the next segment. Get a copy of that policy, read that policy, right? I remember when I was younger, I just signed a whole bunch of paperwork on my first day of work, not realizing that there were insurance policy paperwork, long-term disability insurance paperwork I was signing, and some other types of insurance that I was signing for that I just received as a benefit as an employee. I wish I had somebody who had told me to read that policy. I may have been able to borrow against that money. At one particular point in time, I had a significant life event. And so it would have been nice to know that, was there money that I could borrow against from that policy, from all the money that I had already paid in, that I could then leverage and use to help me out of my financial situation. So what I want you to do is go to your employer, go to your HR department, see, hey, does this company have a life insurance policy that I've signed on to? If you already know that you have a life insurance policy as part of your work, get a copy of that life insurance policy. Go this weekend, and I want you to review and highlight anything that is of a question. You know what? Post it on our website. Post it on the post here on YouTube. I will answer as many questions as I possibly can. And if I can't answer it, somebody from the community can possibly answer it. But I want you to start looking into this. Look, some of your credit cards. Look at your credit cards. If you look at the benefits of your credit cards, some of your credit cards may have some kind of insurance. I remember a few years ago, I bought a brand new computer. I went on a trip, ended up spilling water in the computer. The computer was fried. I literally had the laptop for 3 days. I was heartbroken. Turned out my credit card had insurance that was going to replace the product, right? Because I had not taken the insurance that was available through the company that made the laptop, my credit card covered the insurance. So these are all smaller, different ways of like, how can you secure your investment? This investment of a laptop, it was a $3,500 laptop. So to know that it was now replaced in whole by my credit card company was absolutely amazing, right? Saved myself another $3,500. So what would have been maybe a $6,000 expense was now a $3,500 expense, right? And I think I just had to pay a small deductible to them. But these are the things. There's travel insurance, works the same way, but there are all these things that are meant to protect you that you don't even know about and nobody's telling you about. So definitely review your credit card benefits. Definitely go into your workplace and see if there is something there that either they've provided you or something that you don't know about that they're providing you. Maybe you've just forgotten. You've been working at the same company for 20 years or 10 years. You've forgotten what they offer. Go find out and see if there's anything that you can do. Can you borrow against that policy? What are the rules against borrowing against that policy? If you're looking to buy a home, you might be able to borrow your down payment for your home with that policy. And these are all the things that you want to be aware of and see if they're going to, if you have these advantages that you can leverage, right? So that's it for this segment on the benefits and the risk of using insurance as an investment. Remember, using both the benefits and the risks can help you make informed decisions and use insurance to enhance your financial strategy. So I hope you come back and join us in the last segment. Stay tuned because in the next segment, we're going to talk about some of the practical steps that you need to get started with leveraging insurance as an investment tool. So make sure you join us back after the break, and I'll show you how to do different better. Welcome back to the Do Different Better Show. I'm your host, Elaine Rasmussen. Just before the break, we started getting into understanding the benefits and the risk of using insurance as an investment strategy. So that to help you make informed decisions and use insurance to enhance your financial investing journey. In this final segment, we're going to do a dive into what are some of the practical steps that you need to get started with using insurance as an investment tool. I want to make sure that you are well equipped to make some informed decisions and integrate insurance into your financial strategy effectively. So, first things first, you need to evaluate your needs and your goals. I know I say this on almost every episode, but I'm saying it because it's so important. If you don't know where you're going, you're not going to know when you're off track, right? And you really want to make sure that you are heading in that North Star of wherever you're trying to go. And before the break, I talked about, hey, you might be anticipating making a large asset purchase. Maybe you're looking to make an investment, buy an investment property. Maybe you're looking to expand your your family. Maybe you're looking to adopt. Well, those are going to have expenses. And if you can plan of like, oh, I think this is when those things might happen, you can create a strategy, financial strategy that's going to support you in that, right? So it's really essential to understand whether you're using insurance as an investment that aligns with your overall financial objectives. So the first thing in doing your personal assessment, take a moment to reflect on your financial goals. Are you looking for stability? Are you looking for guaranteed returns? Do you want to ensure your family is financially protected in the event of your passing? Are you interested in leveraging tax advantages? Write down your short and long-term financial goals. This can help you determine if an insurance investment fits into your broader plan, particularly if you're going to start working with a certified financial planner or an investment advisor. They're going to ask you these questions, but I always find it's really good idea to work through these questions ahead of time. You may not have all the answers, and that's okay. It's not a quiz. The advisor is not going to mark you down for not being able to answer their question. But to make sure that you make the best use of their time and your time, think about some of these questions in advance. So when you get into that meeting and they ask you these questions, you've at least germinated, and new things might come up because you've already thought about them a little bit before you stepped into the meeting. Number two, financial planning. Integrating insurance into your financial plan involves looking at your current assets and liabilities, right? The things that you own and the things that you owe, OWE, and your overall financial health. Are you in a very living paycheck to paycheck? That's a very different situation than you might have some discretionary income at the end of the month, which is a very different situation if you get a quarterly or annual bonus every year. So, looking at where you're sitting, how much risk are you willing to take? If you're living paycheck to paycheck, you do not have a lot of room for risk, right? Meaning that if you make an investment, you don't have a lot of wiggle room if that investment fails, right? As opposed to somebody who I get an annual commission check, or I get an annual bonus check. I'm using that money to start my investment journey, right? Now you're covering all your expenses, and now this is extra money that you're now going to leverage to launch your financial journey. Whatever the situation is, really understanding how much risk you can actually take, how much risk you're willing to take, and what is the time horizon to see any kind of returns, and what kind of returns do you need to see? Are you like, hey, I'm older, I'm not looking for big returns, I just need a steady income because I'm getting ready to go into retirement. I would love there to be 200, 500, an extra $1,000 every month that drops into my bank account, right? As a result of my investments, as opposed to somebody else who's like, hey, at the end of the year, I want to have made 20, 30, $40,000. That's a different investment strategy. And then the second thing I just wanted to talk about a fun fact, right? So a well-balanced financial plan often includes a mix of insurance, savings, and other investment vehicles that provide you with security and growth. So, once again, understanding your personal needs and goals is crucial in deciding whether insurance as an investment is good for you. So, now let's move on to choosing the right products. There are several different insurance products out there, and choosing the right one can be overwhelming. But here's how you can make an informed decision. The first thing is do your research. I know I talk about this a lot. Do your research, do your research, do your research. Once again, if you've decided to join an investment club, talk to some of your colleagues and find out what have they found successful with? Why did they choose those things? A lot of times, if you're already in an investment club, you're having these conversations anyway. So it's not a big deal to kind of expand the conversation. Be like, are you using insurance as an investment? How are you using insurance? How is it paid off? What mistakes have you made? Find out, but do your research and find out. Start by researching the different types of insurance products available. Look into whole life, universal life, variable life, annuities, and long-term insurance care. Use resources like Insurance Information Institute, III, and financial news websites to compare different products. Pay attention to the features, the benefits, the costs, and the payout or liquidity, right? How quickly can you get money out? What are the penalties of getting money out? What are the fees or the premiums on a regular basis, right? 2, get professional advice. Consulting with a financial advisor or insurance professional is important. Once again, we talk about this in the next episode. Oftentimes, a certified financial planner or an investment advisor can refer you to somebody either in their office, into their organization, or some other people that they have worked with or their clients have worked with that can help you. They can provide you very personalized advice based on your financial situation and your goals. When you're choosing an advisor, make sure that they're licensed and they have a good track record. Do not be afraid to ask for references and check their credentials. Asking for referrals from their current clients is a good idea. Oftentimes, they have already had that conversation with clients of like, hey, if somebody is looking to talk to you, is it okay that I share your information? Or they may send your information to the client and ask the client to reach it back out to you. Number 3, identify key questions. When evaluating insurance policies, ask some of the following questions. What are the fees and costs associated with this policy? How does the policy cash value grow over time? And at what rate? Are there penalties for accessing the cash value? What are the tax implications of this policy, both in purchasing it, but also at time of payout, or if you take a loan against it at that particular point. So at any time that money is taken out, whether it be at the end of the term of the policy, whether it be in the middle, or whether it be in the beginning. What are the tax implications of this policy? So here is my call to action. Make a list of these questions and use them as a checklist when discussing the options with your advisor. So I really want to talk now about what are some practical and tactical steps that you can do. As far as now, we're going to talk about some practical and tactical steps and how you can use insurance as your investment tool. So the first thing is create a plan. If you work the plan to work, right? Start by reviewing your current insurance policies. And we talked a little bit about that before, right? See if you have an insurance policy with your job. See if you have an insurance policy with your credit card company. Your credit card company might have some kind of life insurance benefit. It just depends. You can go, usually most credit cards, if you go to the website, you look up benefits, you can kind of read all of your benefits right there on the website. But I think many times it just comes on your statement. So if you just pull out your last credit card statement, your benefits might be listed on there as well. But nowadays, most of the credit card companies, once you log into your account, it'll tell you exactly what your benefits are. You'll be able to see what those are. So really just assessing large scale, all the possible opportunities where some kind of insurance policy might exist. So usually with your employer, possibly with your credit cards, or check to see if your parents, you may have a sub policy as part of your parents. Your aunts and uncles. I had a friend of mine, because they were the only other living relative of their nieces and nephews, the uncle or the uncle and the aunt actually had life insurance policies on their nieces and nephews. Now, to do that, you have to get permission from the parents, but they had these policies. So ask your family, is there anybody, am I on anybody's life insurance policy? Very similar to a car insurance. You can have your children on your car insurance. And if you're the one who has a policy on a person that is other than yourself, let them know. Don't presume that they know. Even if you've told them, if you told them more than 12 months ago, you probably should tell them again. And because if that person is listening to this show, they're going to want to need to know how they're going to be out, what are all of the leverage points of leverage that they can in building their financial strategy, right? Don't keep it a secret. If you're holding insurance for somebody, do not keep it a secret. It is not helpful for them to not know that they have an insurance policy that's available to them to be leveraged as part of their portfolio. Even if that insurance policy doesn't pay out for 20 years, letting them know so that they can take that information to their financial advisor, so that can be a critical part of their financial planning. So please, 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 please share financial information with people who are involved in your financial strategy, right? It does not help to keep it a secret, including wills, including a trust. If you have somebody in your trust, please, please, please let them know. They don't want to be surprised with any expenses or anything like costs that are associated after you pass, right? So little sidebar, but I thought it was really, really important, right? So have an action plan. Number two, here are some recommended resources to help you on your journey. There's the book, The Wealthy Barber by David Chilton. There's Money, Wealth, Life, and Insurance by Jake Thompson. There's some great websites like I talked about. There's the Insurance Information Institute. There's Investopedia's insurance section. Investopedia is really great. There's also lots of new tools that are coming out. We've talked about financial AI tools that are available as well that can help you in this journey. A lot of the platforms like the Charles Schwab's and the JP Morgan Chase platform, they're incorporating that. So those are also good places. But know that if there's a company behind them as opposed to a nonprofit third party, they are going to be pushing their own products. So just have that lens of discretion when you're looking at anything that's on a particular company website. They're obviously meant to push their own products and services, right? But then there's also lots of tools to use online calculators to estimate potential returns and costs of different policies. So Here's my call to action. I challenge you to take a proactive step today, this moment, right as soon as this show is over. Review your current insurance policies and see if there's any potential for investment opportunities with them. Maybe you're able to take money out to buy, to put a down payment on a home or an investment property. Check with your employer. Many employers sign you up with a life insurance policy as part of your benefits package during onboarding. Check with HR and see what, if any, policies exist and get copies of those policies. Ask if the company holds a policy for which the company is a beneficiary. Some large companies have what's called a dead peasant policy. I know it's a terrible name. I didn't make it up. A dead peasant policy means if you died as a current employee or a separated employee, the company benefits without your knowledge. Meaning, if they take out a $10,000 policy on you, if you leave the company 30 days from now and you get hit by a car, they get paid $10,000 and none of that money goes to your family, right? Excuse me. Since 2006, legally, companies have to inform if there is a dead peasant policy on your life. But many companies may have been grandfathered in and exempt from getting your consent. So once again, go to your employer and find out all these policies. If you don't have an insurance policy yet, research and consult with a financial advisor to explore what your options are. Here is a fun fact. Did you know that integrating insurance into your financial plan can provide both peace of mind and financial growth? It's really a win-win. And it's just so accessible. It's so simple. I shouldn't say that. That's not real. It can be simple. Once you kind of get into it, anything new is going to be confusing. Anything new is going to be overwhelming. But once you kind of understand some of the basics, once again, if you're working with an advisor, they can walk you through all of this and help you walk through this roadmap. But once again, you just really want to find out currently where you are and see what options are available to you. And if you decide to go with a financial planner, take all that information with you to the financial planner and say, hey, I don't know what to do with all of this, but here's everything that I know at this moment. And they will cull all of that together and they will put it into a nice, beautiful presentation, spreadsheet. Many of them have platforms where you can look at the platform on a regular basis, 24 hours a day, and you can see how all of your things are working with each other, how your financial instruments are working with each other, and the implications of each instrument, whether it be insurance or whether it be stocks or whether it be bonds or whether it be other types of things, even your savings, right? If that's what you're trying to do. So that's it for today's episode on insurance as an investment tool. Today, we covered the broad strokes of understanding insurance as an investment tool. We talked about what is insurance, the different types of insurance, and how insurance works. We also uncovered some of the benefits and some of the risks of using insurance as an investment tool to enhance your personal financial investing strategy. And finally, I gave you some practical and tactical tips to get you started with using insurance as an investment tool. We even talked about the movie The Big Short and Dead Peasant Insurance. And if you don't know, now you know. I hope you feel empowered to take control of your financial future and consider how insurance can play a role in your wealth building strategy. Thank you for tuning in to the Do Different Better Show. I'm your host, Elaine Rasmussen. If you have found this episode helpful, please subscribe and leave a review and share it with friends. Join me in the next episode called The Role of a Financial Advisor, Finding the Right Fit for You. This episode is packed with insider tips on understanding what a financial advisor does, how to find the perfect one for your financial needs, and how to know when it's time to part ways. Whether you're just starting out or looking to manage substantial wealth, this episode will arm you with the knowledge and confidence to make the best decisions for your financial future. So I'll see you next week when I show you how to do different better. Let me know what you think of the show. We love comments. So tell us how this show helped you. If there's a money or finance question that you have, or if there's someone you want me to interview, hit me up on LinkedIn or Instagram. Don't forget to hit the subscribe button and follow us on all of our socials. See you next time.